Good. There's a disclaimer, as usual, just to say exactly that. I'm not allowed to give you advice. Just a bit about QuotedData first, for those who don't know us. So we're funded by the industry to provide research to you for free. It's not just research, though, although that's a big chunk of what we do. And if you go down to the stand, there's loads of stuff on there. We've also got news every day. So there's always somebody looking at the RNSs, trying to put that up there. And we send that out as a daily email now. So that's an optional thing. You don't have to have it. But we also do a weekly roundup, too. And then there's data, which we draw from Morningstar. And it just allows you to look at companies by sector. You can rank them on discount. You can rank them on yield. You can look at their performance track record and rank them on that. And then underneath every single one of those, there's a page which has got more information on it. And just encourage you to just go on the site and play if you haven't done it before. There's plenty to see on there. And there's also, actually, if you hunt around, there's actually some educational stuff too. So if you don't know much about investment companies, that's all there as well. And then one of the things that we've done a lot more of recently is doing videos. So every Friday, we have me doing a sort of roundup of the week's news. And then we interview a fund manager. Or occasionally, as we did yesterday, we have a panel on a topic. So we're going to try and do that every month going forward. So firstly, I've got an apology to make, really. So when we were here last time, I was really quite hopeful that after an extended period where discounts have been widening across the sector, that we'd actually see some improvement. It didn't happen. And there are various reasons for that. We can all list them. The interest rates have come down a bit, but bond yields have stayed high. That's not helped some groups of funds. Also, we've still got this ongoing problem with charge disclosures. So if you a wealth manager trying to invest in investment companies for your clients, it just looks horrendously expensive. So they just stop recommending them. And then we had things around the budget as well. People were selling stuff for CGT reasons. We saw that in some really quite solid names. And then AIM things for affecting small cap trusts too. So all of those sort of fed through into that. There were some really terrible ones within that. And again, this is all part of the apology. I was kind of hopeful that there were some big bargains on offer in infrastructure and renewable energy that I was trying to highlight last year. Those bargains sort of got better, if you want to put it that way around. And also UK logistics. And those sort of widening discounts are starting to attract different sorts of investors to other, just you and me. There were some that improved, but a lot of this is actually down to activism. And there's been one player in particular that's been grabbing headlines and making a lot of noise in the sector, and who's responsible for some of this, and that's Saba. So this is an American activist hedge fund, and they buy investment companies in the States, short the underlying investments, and try and make money out of narrowing the discounts. And they looked at the market over here and thought, we could do the same thing. And they've deployed a lot of money into the sector, literally billions. And then they did a sort of really kind of inept campaign to try and take advantage of that. So they launched a tax on 7 trusts with the aim of kicking off all of the board members, putting their own people in, and then get themselves appointed as investment manager. So it was a naked attempt to grab assets under management. And not surprisingly, shareholders rejected it. And we were really pleased, actually, by the strength of depth and feeling that we saw. So not only were there a lot of headlines in the mainstream press that we haven't seen talk about investment companies for a long time, but they came out and they showed up and actually did defend the sector. But also campaigns around voting. So one of the things that we've been worried about for a long time is that it's quite hard for you as retail investors to vote your shares, depending on which platform you use. So sorting that out has been a big thing that we needed to get done. So highlighting the fact that even there's a deadline for voting of, say, 21st of January, you needed to get your votes lodged with some of these platforms a week before that, or even more. So voting early. And a lot of what they were doing, they seemed to be targeting companies where a lot of retail investors were on the share register. And because of these difficulties with voting, they thought that people wouldn't vote. But actually, as it turned out, the turnout was actually really quite good in some things. Sometimes it was a record for these trusts. So one of our clients, for example, was Herald. And one of the reasons why Global Small Cap was a riser there, they were buying and buying and buying shares in that. They were building up 29% stakes in these things, just below the level where they need to actually make a bid for them. And then trying to, as I say, seize the assets under management. Shareholders overwhelmingly rejected it. I mean, almost nobody voted with them, which is really encouraging. That's great. But there are other things going on too. So one of the things that we've seen increasingly this year is actual bids for companies. This is something we haven't seen for a long time, but they're just proliferating now. So you can see a whole chunk of them here. Some of these stories are really quite new, but actually I put these slides together just over a week ago, and even just this week there have been more ones coming out as well. So you've got people like Blackstone bidding for warehouse REITs, which is still ongoing. Care REIT actually acquired by a firm. And then some things saying, we can't cope anymore, we're just going to put ourselves up for sale, like Life Sciences REIT there. And we've also seen another activist come into the sector. And there are plenty, not just these two, there are plenty of these people that invest on big discounts and try and take advantage of them. And they're trying to sort of buy at a discount and then get out at asset value. But Achilles is interesting because it's quite akin to what I used to do. So if you go back dim and distant past, after a spell when I ran the Energy Fund of Investment Trusts, I then for 10 years ran a fund called Advance UK. And we were a listed investment company, like Achilles is, that was funded by investors that were stuck in things on big discounts and frustrated that they couldn't get out of them. And so we weren't very big. The very biggest we got to is 100 million. Achilles is just 52. But it didn't matter. We weren't doing a Saba where we were deploying billions of pounds to try and get force a result through. We were pinning to shareholders and saying, this isn't working, something has to change, vote with us and we'll help sort it out. And this is what Achilles are planning to do too. So their first target is Urban Logistics REIT. We weren't massively happy with that because it's one of our clients. And actually, the thing with this, I would really not like them to end up trying to find a buyer for it. That might be what happens. One of the things that I've been quite sad about and worried about is that investors are selling these things out at the bottom. Even if they get close to NAV for them, they're still actually exiting far too cheaply. And I think this would be true here. But there are things that they want to fix with Urban Logistics REIT, and there's a war of words going on in the press now, and you'll see that develop over the next couple of weeks. So I don't have a problem with them. They're not just trying to asset gather the way that Saba was. They are actually trying to achieve things, and it's interesting, when they did the requisition for a meeting with Urban Logistics REIT, they had people signed up with them, like TR Property Trust, so manager we really rate. Waverton is a big wealth manager, and these are investors in the Urban Logistics REIT, and they're frustrated, and they want something to happen, and they want Achilles to be the key to unlock that. So that's good. And then we've also seen cash bids for things like BBGI Global Infrastructure. That's incredible, really. I've been saying for ages that these bids are going to happen, and they just haven't happened. And now we are actually starting to see them. So there's that one there. And the other one I want to highlight is Harmony Energy. And again, I was talking about Foresight there. And since I wrote that, Drax came along and topped the offer that Foresight made. And then we've got a whole raft of other things going on. It's not just about takeovers or activists. A lot of boards are saying, we need to do something about this. We're going to take some kind of action. We do tender offers, continuation votes. We're going to introduce lower management fees as a very common thing we've seen in the last couple of weeks, and there were a raft of announcements of that this week. And the one I've highlighted there is Foresight Solar, because again, we've been talking about renewables trusts as we were last year, and the frustrations with discounts. It has come to a point now where we've been going for ages, these are too cheap, and we were hoping that investors would come in and buy the stock and drive the discounts down and everything would get back to normal. That hasn't happened, and so we are getting to the point where something more drastic will probably happen. And we're seeing that at the margin. So some things that didn't work, like Aquila energy efficiency, they're just winding up. That's already on the way out. Harmony Energy Income, it's a battery storage fund. It was deploying its money. It did that fairly efficiently, but then the battery storage companies ran into problems that they couldn't get the national grid to actually use their services. So they were all plugged into the system, and the national grid wasn't using them. So their income fell off a cliff. They all went to big discounts. And the board of Harmony Energy said, this is not sustainable. We have to do something about this. And so they effectively put the company up for sale. And then, as I say, there's been a bit of a bidding war going on in the background. We weren't really aware of it until recently, but then Foresight said, we've bid this price. And then last week, there was a bid from Drax at a 4.5% discount to NAV. And that is really remarkable when you look at the discounts that are there on the other two battery storage funds. So the closest to Harmony is the Gresham House Energy Storage one. I do kind of think that that's it's waiting to happen, that something will happen to that, given where that discount is. It just doesn't make sense to me that you could have a takeout at 4.5 and then you have something directly comparable trading at almost 50%. So if that went out at 4.5% discount, you are making 80, 90% on your money. And then the other thing that I wanted to stress about these is the yields. So because the share prices are so low relative to where the assets are, the yields are really enormous. And I do think, for the most part, you might argue about the battery storage funds because we've got this issue about are they earning decent money or not, and the longevity of their contracts. It's just sort of still up to debate because it's a very new sector. But for the solar funds, the wind funds, they've got a lot of subsidy income, which is guaranteed, inflation-linked, out for sort of 10 years or more. That income stream is fairly safe, and it's also covered by cash earnings. I don't think there's any one of those ones that is not covered by earnings. And so you've got, for me, the win-win is you can buy them now and collect a double-digit yield for the foreseeable, or something will come along and actually take it out closer to asset value, and you'll make a big capital gain. That's where I think the win-win is. So there are other sort of outliers in there. Hydrogen One is not like the others. It's one that we've written on, and we've got notes available on the stand. It's not trying to produce an income. It's investing in hydrogen assets. And they've had issues with some things. They've had one company go bust within the portfolio. So ignore that one. And I'm not saying it's not cheap, and not saying that something might happen to it, because it might do. But the other lot, I think, are worth having a closer look at. And the same is true in infrastructure too. So here we've had the BBGI bid, and that's still trading on a small discount. I don't think any of you is going to bother to invest in something just to get a 4% discount closing, but maybe you will. But a lot of these other ones are interesting. Things like Cordiant. So Digital 9 was a disaster. I think I recognised that last year. We talked about it. But Cordiant is a much better run company, much better assets within it. It got dragged down when Digital 9 ran into trouble. People say, we don't like digital infrastructure. Actually, it's not a bad investment. And that's also true in Pantheon, which has got a chunk of its assets in digital infrastructure. And you can see that in Pantheon's NAV returns. They're some of the best in the sector. It's a bit like 3i in that it is buying not just for income, it's also building infrastructure assets and getting a capital uplift on those. We think that that is actually going to be a decent fund going forward. But then you've also got things like Hickle, where I've seen people starting to talk now about that as a bid target, which was unthinkable for a long time, but it might happen. So short and sweet, I think I'm slightly early, only about a minute. If you've got any questions on this, rather than doing them now, do come and see us down on the stand. There's loads of research there. We've given away a lot already, but you can just take it away for free, print out copies, or sign up for the research that's on the QuotedData website. Do go on there, have a play, as I say. It's all free. We've got this YouTube channel, which has got loads of videos and stuff on it now, and we're doing more and more and more of that stuff. And then the other thing that we launched last year that I'd encourage you all to take part in, we're doing awards on investment companies, but rather than having a sort of group of wealth managers choosing the winners, which is what normally happens, we want you, the investors, to decide who the best companies are. So we're asking you to come on and vote on the awards once we've got a shortlist. That'll come out in the next couple of months. And last year we gave £5,000 prize to the person that came closest to picking the winners. And I think we're going to do the same again this year, but watch this space. So thank you very much, and I'll hand back to Matthew.